Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons and I'm with Greg Willett, the head of research and analysis at MPF Research. And today it's 3 states for the price of 1 as we look at Gulf Coast states not named Florida or Texas. So that leaves the Deep South, Alabama, Mississippi, as well as Louisiana. And we'll look at 4 markets in those states: Birmingham, Jackson, New Orleans, and Baton Rouge. And Greg, let's start with the biggest of the bunch, New Orleans. Obviously an area that's really struggled to get back to where it was prior to Hurricane Katrina. What are we seeing right now in the apartment market there?
I like that you picked the tough one to start with and then just immediately throw it to me.
Absolutely.
And let's jump in there with the numbers. Bring up a graphic here for you with the stats as of first quarter. You can see that occupancy in the Big Easy, after getting all the way down to 89% during the recession, has made some progress, but the number is still pretty low at 91.3% on the occupancy rate. The rent stats look a little bit better. We have effective rents now up 2.4% specifically for first quarter, and the annual increase is at 3.3%, with average monthly rents now at $825. Jay, there is some variation by product sector. The best performers are the top tier properties. They have occupancy that is getting up close to that 94% mark. But that's come with some sacrifices on rent production, with effective rents just barely moving up 0.3% during the course of the past year. And when you look at New Orleans, I mean, you really don't want to make too many generalizations about what happened since Hurricane Katrina. It's obviously a unique experience for every individual who went through that. It's a different story for each apartment property, but I think you can make a couple of generalizations about what's happened with the renter populace. And the key thing would be, as the folks from New Orleans spread out into other markets, the people who really hit the ground running, adapted to their new environments, educated young professionals and working class families tended to do the best. And so those were the people who often ended up staying wherever they relocated to. And so that really has sort of changed who lives in apartments in New Orleans.
And obviously, one market that's really gained a lot of people who were living in New Orleans was Baton Rouge. We're going to go up I-10 and look at this market. And this is a pretty unique market as well. Obviously one that, as we mentioned earlier, has gained some residents from New Orleans, but it's also an area that's a state capital and home to a major university, LSU. And markets of that have those two things together, the state capital plus a major university, they tend to have held up better during the recession. And Baton Rouge was pretty much no exception. Take a look at this occupancy chart. Very tight rates, especially for a southern market prior to the recession, with occupancy rates above 97%. And occupancy dropped as low as only 93.1%. Really not bad at all, especially in comparison to some of the other Gulf Coast metros we're going to be talking about today. And as of 1Q, occupancy came in at 93.6%. We're seeing pretty similar rates across Baton Rouge's various submarkets. So because occupancy didn't get in a particularly big hole, we didn't see rents fall especially hard here. Take a look at this rent chart here. You see annual rent change by quarter. For most everywhere in the country, 2009 was a really rough year for rent loss, but not in Baton Rouge. Cuts here got as deep as only 1.6%. And as of 1Q, same-store rents are up 3.5%, which is essentially in line with the U.S. and South regional averages. So not particularly aggressive growth, and that's simply because apartment demand has not come back yet, and that you could trace to the fact that the job market hasn't picked up yet. As I mentioned earlier, this is a market that is heavily dependent on government and education, and they're a little bit behind the cycle in terms of job growth, so we're just not seeing apartment demand come back yet, and as a result, rent growth has been very limited.
From Louisiana, let's jump on over to Mississippi and take a look at what is happening in the Jackson marketplace. Again, we've got a graphic for you here with some basic stats. As in some of the other markets, a pretty big hit during the recession on occupancy. For Jackson, we got all the way down to 89%. We've made some progress since then. We're now up to 92.5% on the occupancy rate as of first quarter. An okay number, but not spectacular. There is a pretty strong performance, though, from properties from the 2000s, the 1990s, the 1980s. Those are all 94, 95% occupied, and then you get down to that oldest, least desirable product segment in Jackson, and the occupancy numbers are just horrible in those. Rent growth in this one over the course of the past year, up 4.5%, with 2% of that coming specifically during first quarter. That 4.5% rent growth number, best of these markets that we're looking at, and also a pretty decent premium over what the U.S. as a whole has done. And the top tier properties to the middle tier with the solid occupancy, that's where all that rent growth is coming in. The overall story for Jackson, moderate momentum, and that really reflects what's happening in the economy as well. About 2,000 jobs created in this market during the course of the past year. Not a huge number, but it's a pretty small market, so that's 0.8% growth on an annual basis. Okay.
And from there, let's take a short 4-hour drive west on I-20 to Birmingham. And here's a market that just nosedived in the second half of 2008, as did many a metro across the U.S. Occupancy fell from around 95% to below 90%, and it hovered around 88 to 89% until the middle of 2010. Occupancy did get above 92% in 3Q of last year, but as of 1Q, it's fallen down again. It's back to 90.5%. And that in the recession, as we talked about, a lot of these southern markets really put a big hole, especially at the bottom end of the market. On the pricing side, rents fell as low as 4% year over year in the recession, and they've been steadily improving of late. Same-store rent growth of 2.4% in the year ending March. Not bad. And one thing to point out in Birmingham, and this is probably no surprise, is that the southern suburbs of Birmingham, like the Hoover area, have certainly outperformed the metro as a whole. Fewer vacancies and much better rent growth in that part of the market. So Greg, let's wrap things up. Taking a look at these 4 markets as a whole, you got to put your money in one place. Which one are you choosing? Well,
looking at them in respect to the nation as a whole, I'll point out that none of these are really stellar ones. I mean, if we were looking at comparably sized markets across the country, we would certainly go with the second-tier markets in places like Texas and the Carolinas. But among these 4, and you think I'm going to say Baton Rouge, don't you? And we do like some stabilizing forces there, but in terms of near-term momentum, I would actually probably go with Jackson. It's encouraging that you've got a pretty full recovery in that top tier of the market, so you're kind of waiting for it to trickle down into the rest of the marketplace. And then one other thing to point out about that one, compared to the other markets, it has a bigger share of total employment in healthcare, and it just never hurts to have an economic specialty in a growing industry.
So there you have it, maybe a surprise pick for the Deep South, Jackson, Mississippi. So that wraps us up for Apart Market Dynamics. For Greg Willett and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.